Hello, AG Asian guy here. Ready to explore how money shaped the world? The futures exchanges are closed for the weekend and the trading desks are dark. And yet, silver is continuing to move lower, trading at $64.93. This reflects a decline of $2.75 or 4.07%. Gold is currently trading at $4,339.10. These are not prices generated by primary futures exchange activity. They reflect movement in markets that continued through the weekend after formal trading ended. Friday's session alone saw silver close at $67.69 bid. This was a single-day decline of $5, or 6.88%. Gold's Friday close came in at $4,490.20. Since Friday's close, silver has declined an additional $2.76. Gold has declined an additional $151.10. Sunday's silver session moved between a low of $64.88 and a high of $69.73. Gold's Sunday session ran from a low of $4,333. From the January 2026 high of $121, silver has declined over 46%. This places the event within an extremely narrow historical category of silver market events, a category containing only two prior comparable episodes with completely different outcomes. Is the current decline a permanent end to the bull market or a violent interruption before recovery? That question is answered by the data underlying the price rather than the price itself. This includes supply figures, monetary policy constraints, and physical vault activity. All data in this broadcast is sourced from public market data and mining sector filings. No financial recommendations or buy and sell guidance are offered here. The analysis of silver must begin with the physical supply picture. The most relevant historical comparison for a decline of this magnitude is January 1980. In 1980, silver ran to $50.50, driven by the Hunt brothers. The COMEX responded with emergency rule changes that effectively prohibited new long purchases. Critically, the supply of silver was not constrained at the time of that 1980 crash. There was no shortage of physical metal, and the price spike was entirely artificial. The supply picture in 2026 is structurally different from 1980 in documented ways. 95% of all silver ever mined has been industrially consumed and is unrecoverable. It is contained in landfills and electronic waste that cannot be economically extracted. By every practical measure of the refining industry, that silver is permanently gone. In contrast, 95% of all gold ever found in history is still in existence. Gold accumulates across centuries while silver disappears into modern industrial products. Industrial demand for silver is not contracting, but growing in key sectors. Solar energy, electric vehicles, and artificial intelligence infrastructure all require silver. None of these demand sources can be substituted without significant performance loss. Silver production has been essentially stagnant for years with no major new projects. Mining sector capital expenditure is reported to be near record lows on an adjusted basis. Major silver producers operate at a sustaining cost of $12 to $15 per ounce. Even with wide margins, the capital required to expand production is not materializing. The timeline from initial discovery to commercial production is between 7 and 10 years. Projects planned today will not deliver meaningful new supply until 2032. At the earliest, a significant vault withdrawal episode occurred in December 2025. In 4 trading days, 47.6 million ounces were withdrawn from COMEX vaults. This represented 60% of the entire registered inventory removed in less than a week. The institutions involved were industrial buyers and sovereign entities with procurement obligations. When 60% of the inventory departed, the price of silver moved only marginally. The physical reality and the paper price were operating as two functionally independent systems. The paper pricing mechanism failed to reflect the departure of the majority of registered metal. This indicates a widening structural separation between the paper and physical markets. The supply deficit moves with geological and capital cycles operating on decade scales. A sell-off, driven by margin calls, does not change the geology of silver or deposits. This evidence suggests the current decline is a mechanical interruption rather than an ending. The second category of evidence concerns whether policymakers can use the tools of 1980. In 1980, Chairman Paul Volcker raised the federal funds rate to 20%. That decision broke the commodity bull market by making government bonds more attractive. Volcker could execute this because the national debt was then under $1 trillion. The United States national debt today stands at $38 trillion. The government adds approximately $1 trillion to that debt every 100 days. A 20% interest rate today would produce an annual interest expense of $7.6 trillion. Total annual federal revenue is currently only approximately $5 trillion. Interest obligations would exceed total revenue by over $2 trillion, making it impossible. The Federal Reserve is trapped between high inflation and debt service arithmetic. They cannot raise rates to genuine containment levels without causing a fiscal crisis. The mechanism that ended the last silver supercycle is arithmetically unavailable today. We now turn to the historical construction of the paper silver pricing mechanism. A December 1974, Embassy Cable documented a meeting with major London metals dealers. This was 21 days before silver futures trading was legally open to Americans. Dealers stated that large futures volume would negate long-term hoarding by U.S. citizens. The mechanism to engineer paper preference over physical ownership was documented before it existed. In 2020, J.P. Morgan Chase entered a guilty plea for market manipulation in precious metals. Traders within the bank's desk were documented spoofing markets for over a decade. J.P. Morgan paid $920 million in penalties for these federal charges. The guilty plea confirmed the paper market had been actively manipulated for 10 years. These documents established that the suppression mechanism is a confirmed legal fact. When a paper suppression mechanism loses its grip, the subsequent price move is massive. Between 1971 and 1980, silver rose approximately 3,700%. That rally ended only because of a rate hike that is now impossible to repeat. Oil near $170 per barrel is now driving agricultural costs higher. Agricultural inflation is accumulating on top of energy inflation across the economy. The gold bugs index has declined 28% from its recent cycle high. The MACD indicator is reading negative 33, an extreme oversold level. This technical fingerprint represents forced liquidations rather than discretionary exits. The Philadelphia Gold and Silver Index has pulled back to its original breakout level. In technical analysis, a successful retest of a breakout level is called a throwback. If this level holds, the next mining rally launches from a powerful foundation. Mining stocks currently represent only 1% of total global equity capitalization. In the 1970s, mining stocks represented 12% of global equity capitalization. A re-rate to just 6% would represent a 6 times multiple of current values. Mining operating cash flows are currently extraordinary by any standard measure. The convergence of these data points defines the analytical picture of the silver market. The current decline resembles the mechanical interruptions of 2020 more than 1980. Physical demand remains real, as evidenced by the massive December vault withdrawals. The fiscal mathematics of 2026 confirm that the Volcker suppression tool is gone. The structural separation between physical reality and paper pricing continues to widen. This has been a data-driven examination of the global silver market mechanics. We will continue to monitor the vault records and exchange data as they update.